Are you preparing for the NMLS SAFE mortgage loan exam and looking for an effective way to master key concepts? In this video, we'll dive into the top 200 NMLS mortgage loan exam flashcards to help you confidently tackle the test. From federal mortgage laws to ethical practices, these flashcards cover everything you need to know. Let's get started.
Qualified mortgage, in simple terms, it is a safe type of loan with strict rules to protect both borrowers and lenders. As per textbook definition, qualified mortgage is a home loan that meets specific criteria under the ability to repay rule, offering legal protection to lenders from borrower lawsuits.
Qualified residential mortgage. In simple terms, it is a safer type of mortgage that follows strict rules set by the government. As per textbook definition, qualified residential mortgage is a type of mortgage that meets certain requirements, allowing it to be exempt from credit risk retention rules.
Quitclaim deed, in simple terms, it is a document that transfers property ownership without promising the title is clear. As per textbook definition, quitclaim deed is a deed transferring ownership of property without making any guarantees about the title.
Real estate agent. In simple terms, it is someone who helps people buy or sell homes. As per textbook definition, real estate agent is a professional who assists buyers and sellers in real estate transactions.
Real Estate Investment Trust (REIT). In simple terms, it is a company that lets you invest in real estate without directly owning properties. As per textbook definition, Real Estate Investment Trust (REIT) is a company that owns or finances real estate properties and provides a way for individuals to invest in real estate without directly managing properties.
Real Estate Settlement Procedures Act, RESPA. In simple terms, it is a law that makes sure lenders give clear information about home buying costs and bans unfair practices. As per textbook definition, Real Estate Settlement Procedures Act, RESPA, is a law that requires lenders to provide clear information about real estate transactions, including costs.
Refinance, in simple terms, it is getting a new mortgage to replace your old one, usually for better terms or rates. As per textbook definition, refinance is replacing an existing mortgage with a new one, often to get a lower interest rate or change loan terms.
Regulation B, in simple terms. It is rules under ECOA that prevent discrimination and require lenders to explain loan decisions. As per textbook definition, Regulation B implements ECOA by ensuring fair lending practices and requiring lenders to notify borrowers of credit decisions.
Regulation X, in simple terms, it is rules under RESPA that manage how lenders handle mortgages and disclose costs. As per textbook definition, Regulation X implements RESPA by setting rules for mortgage servicing and settlement processes, including escrow accounts and disclosures.
Regulation Z, in simple terms. It is rules under TILA that make sure loan costs are explained clearly and consistently. As per textbook definition, Regulation Z implements TILA by standardizing how loan costs are calculated and disclosed to borrowers.
Regulatory compliance. In simple terms, it is following all the rules and laws related to financial services. As per textbook definition, regulatory compliance is adherence to laws and regulations governing financial activities.
REO, in simple terms, it is a property the bank owns after foreclosure. As per textbook definition, REO is real estate owned refers to properties owned by a lender, typically after an unsuccessful foreclosure auction.
RESPA, In simple terms, it is a law that makes sure lenders give clear information about home buying costs and bans unfair practices. As per textbook definition, RESBA is the Real Estate Settlement Procedures Act, ensures transparency by requiring lenders to disclose settlement costs and prohibits kickbacks in real estate transactions.
Retail lender. In simple terms, it is a bank or company that gives loans directly to people buying homes. As per textbook definition, retail lender is a lender that offers mortgage products directly to consumers, often through local branches or online platforms.
Reverse mortgage. In simple terms, it is a way for older homeowners to use their home's value for cash without selling. As per textbook definition, reverse mortgage is a loan that allows homeowners 62 and older to borrow against their home's equity without making monthly mortgage payments.
Right of first refusal. In simple terms, it is the right to be the first one offered to buy a property when the owner decides to sell. As per textbook definition, right of first refusal is a contractual right that gives its holder the option to enter a business transaction with the owner of something before the owner is entitled to enter into that transaction with a third party.
Right of rescission. In simple terms, it is your right to cancel some loans within 3 days without any fees or penalties. As per textbook definition, right of rescission is under TILA. Borrowers have 3 days to cancel certain types of loans after signing the agreement without penalty.
SAFE Act. In simple terms, it is a law that ensures loan officers are trained, tested, and licensed properly. As per textbook definition, SAFE Act is the Secure and Fair Enforcement for Mortgage Licensing Act, requires mortgage loan originators to be licensed and meet specific education and testing requirements.
Secondary market. In simple terms, it is a system where banks sell the mortgages they've made to other companies or investors. As per textbook definition, secondary market is the market where existing mortgages and mortgage-backed securities are bought and sold between lenders and investors.
Secondary mortgage market. In simple terms, it is a system where banks sell the mortgages they've made to other companies or investors. As per textbook definition, secondary mortgage market is the market where existing mortgages and mortgage-backed securities are bought and sold between lenders and investors.
Securitization. In simple terms, it is turning loans into investments that can be bought and sold. As per textbook definition, securitization is the process of converting assets into securities that can be sold to investors.
Servicing rights. In simple terms, it is the ability to handle and collect payments on a loan. As per textbook definition, servicing rights is the rights to manage and collect payments on a mortgage.
Short sale. In simple terms, it is selling your home for less than you owe on the mortgage with the bank's permission. As per textbook definition, short sale is a transaction where a property is sold for less than the amount owed on the mortgage with lender approval to avoid foreclosure.
SOFR. In simple terms, it is a new interest rate standard that's replacing LIBOR for many types of loans. As per textbook definition, SOFR is secured overnight financing rate, a benchmark interest rate that is replacing LIBOR in many financial contracts.
Steering. In simple terms, it is when agents illegally guide buyers to or away from certain areas based on discrimination. As per textbook definition, steering is the illegal practice of influencing a buyer's choice of neighborhoods based on race, religion, or other protected characteristics.
Subordinate financing. In simple terms, it is getting another loan on your home when you already have a mortgage. As per textbook definition, Subordinate financing is additional financing secured by a property that already has a first mortgage, such as a second mortgage or home equity loan.
Subordination, in simple terms, it is deciding which loans get paid first if you can't pay them all back. As per textbook definition, subordination is the process of ranking one debt below another in priority for repayment in case of default, often used with second mortgages or liens.
Subordination agreement. In simple terms, it is deciding which loans get paid first if you can't pay them all back. As per textbook definition, subordination agreement is a document that ranks one debt below another in priority for repayment.
Subprime loan, in simple terms, it is a loan for people with bad credit, usually with higher interest rates. As per textbook definition, subprime loan is a loan offered to borrowers with poor credit history, often at higher interest rates.
Tax implications. In simple terms, it is how financial choices affect how much tax you owe. As per textbook definition, tax implications is the effects of financial decisions on an individual's tax obligations.
TILA, in simple terms, it is a rule requiring lenders to show the real cost of a loan so borrowers can make informed decisions. As per textbook definition, TILA is the Truth in Lending Act mandates lenders to disclose the true cost of credit, including interest rates and fees, to borrowers.
Title insurance. In simple terms, it is insurance to protect buyers and lenders from problems with property ownership records. As per textbook definition, title insurance is insurance that protects against financial loss from defects in title ownership during real estate transactions.
Title search, in simple terms, it is checking public records to make sure the seller owns the property. As per textbook definition, title search is an examination of public records to ensure that the seller has the right to sell a property.
TRID, in simple terms, it is a rule that merges loan forms to make mortgage details easier to understand. As per textbook definition, TRID is the TLA-RESBA Integrated Disclosure Rule, combines loan estimate and closing disclosure forms to simplify mortgage information for borrowers.
Truth in Lending Act TILA. In simple terms, it is a rule requiring lenders to show the real cost of a loan so borrowers can make informed decisions. As per textbook definition, Truth in Lending Act TILA is a law that requires lenders to disclose the true cost of credit to borrowers.
UDAAP. In simple terms, it is rules banning unfair or misleading practices by financial companies. As per textbook definition, UDAAP is unfair, deceptive, or abusive acts or practices are prohibited under the Dodd-Frank Act to protect consumers from harmful financial practices.
Underwriting, in simple terms, it is the step where lenders decide if you're financially able to repay a loan based on your income and credit history. As per textbook definition, underwriting is the process where lenders evaluate a borrower's financial information, income, credit history, to determine whether they qualify for a loan and assess risk levels before approval or denial of the application.
Uniform residential loan application. In simple terms, it is the standard form you fill out to apply for a mortgage. As per textbook definition, uniform residential loan application is the standard form used by nearly all mortgage lenders in the United States to determine whether they will lend money to you.
Uniform Residential Loan Application, URLA. In simple terms, it is the standard form you fill out to apply for a mortgage. As per textbook definition, Uniform Residential Loan Application, URLA, is the standard form used by nearly all mortgage lenders in the United States to determine whether they will lend money to you.
Uniform state content. In simple terms, it is standard mortgage information that all states require loan officers to know. As per textbook definition, uniform state content is standardized information required by NMLS to be included in all state-specific test components.
USDA guarantee fee. In simple terms, it is a fee you pay on USDA loans to help keep the program running. As per textbook definition, USDA guarantee fee is a fee charged on USDA loans to support the program, similar to mortgage insurance on other loan types.
USDA loan. In simple terms, it is a no-down payment loan meant for people buying homes in rural areas. As per textbook definition, USDA loan is a government-backed mortgage program designed for low to moderate-income homebuyers in rural areas, often with no down payment required.
VA funding fee. In simple terms, it is a fee veterans pay when using a VA loan to buy a home. As per textbook definition, VA funding fee is a one-time fee paid to the Department of Veterans Affairs for a VA loan.
VA loan. In simple terms, it is a special loan for military members or veterans with no down payment needed. As per textbook definition, VA loan is a mortgage guaranteed by the Department of Veterans Affairs for eligible veterans, active duty service members, or their families, often requiring no down payment or PMI.
Warehouse line of credit. In simple terms, it is a temporary loan that helps mortgage companies fund new mortgages before selling them. As per textbook definition, warehouse line of credit is a short-term revolving credit facility extended to mortgage bankers to fund loans before they're sold on the secondary market.
Wholesale lender. In simple terms, it is a company that provides loans through middlemen, not directly to homebuyers. As per textbook definition, wholesale lender is a financial institution that offers loans through third parties like mortgage brokers, rather than directly to consumers.
Yield curve. In simple terms, it is a chart that shows how interest rates change for different loan lengths. As per textbook definition, yield curve is a graph showing the relationship between interest rates and the time to maturity for debt of the same credit quality.
Yield spread premium. In simple terms, it is extra money a broker gets for selling you a higher interest rate. As per textbook definition, yield spread premium is a form of compensation paid by a lender to a mortgage broker for selling an interest rate above the par rate.
Zoning. In simple terms, it is rules about how you can use land in different parts of a town or city. As per textbook definition, zoning is local laws that regulate how property in specific areas can be used.